let us start with the brief history of international monetary system. So when we talk about the history of international monetary system, it, it implies that different countries over the course of time adopted different exchange rate mechanisms. That is what we mean by the history of international monetary system. And it starts with the so-called gold standard. Gold has been used as a medium of exchange since, to our knowledge, to the best of our knowledge, since uh, 3000, 3000 before Christ, okay, in ancient Egypt. Okay, gold was used as a medium of exchange. We know that in ancient Mesopotamia, which is Iraq and Syria these days, in ancient India, Indus Valley civilization, perhaps there's some evidence that which suggests that gold was used as a medium of exchange. However, in relatively modern history, around 1870, the countries in Western Europe, they adopted the classical gold standard. Later on, in 1879, the United States joined the so-called gold standard. So under the gold standard, the rules of the game was very clear and simple. Each country set the rate at which its currency could be traded with a given amount of gold. Okay. For example, uh, at the beginning of the World War I, which is roughly the beginning of the 20th century, uh, the price of 1 ounce of gold was $20.67 in the USA. So that was the US government was ready, was willing to buy and sell gold at this price. And this was the value of the US dollar, which was set against gold. Similarly, the British pound was pegged at 4.247 pound sterling, okay, per ounce of gold. So if you want to trade $1 with 1 British pound, the exchange rate between these two currencies was determined by according to the price of gold per ounce in these two countries. So as I said, the price of 1 ounce gold in the USA was $20.67, and in Great Britain it was 4.247 pounds sterling. So the price per US dollar was the price of US dollar, sorry, I repeat, the price of US dollar per pound sterling was 4.87. Okay, so in other words, with 1 British pound, people could buy or sell 4.87 US dollar. So this is how countries used to determine the price of the currency, the exchange rate of two currencies. Okay. So as I said, their policy was very simple. Under the gold standard, the price level was fixed. Okay. The exchange rate was fixed. So each country had to maintain reserves of gold that was sufficient to back its currency's value. Okay. So in the USA, it could issue $20 or $20.67 only if it could increase its stock of gold by 1 ounce. Otherwise, you can't do it. Okay. So the growth of money supply was limited to the rate at which the official authorities, so the government treasuries or the central banks, could acquire additional gold. So this was, so the stock of gold used to determine how much money a government could print, how much money a government could inject into the economy of a country. Okay, so this was the gold standard. Now, we saw the gold standard up until the First World War. When the First World War started in 1914, it became relatively difficult to transfer gold from one country to another country. And apparently, the classical gold standard broke down. It couldn't work as efficiently as it used to previously. So the USA, uh, around this time, USA emerged as the major economy in the world. Okay, so and the USA also changed its gold standard. Okay, the value of US dollar. So previously, I said the price of 1 ounce of gold in the USA was $20.67. In 1934, USA changed that. So in 1934, the US dollar was devalued to $35 per ounce of gold. Okay, and they tried to follow uh, to stabilize the exchange rate, but overall, largely speaking, the period between the two world wars, it was relatively chaotic, and there was a lack of coordination in the international monetary system. Then in 1944, this is a very important year because this is the year when it was the end of the Second World War. So the Allied countries, there were 45 of them, 45 Allied countries, they sat together in a place called Bretton Woods in the USA, in the USA, and they agreed to accept the US dollar as the major currency in the world, trading currency in the world. So it was decided that the value of US dollar would be determined against gold. And by that time, by the end of Second World War, USA has emerged as economic superpower, and it was the largest stock of gold. So the participating countries in the Bretton Woods conference, they accepted that the price of 1 ounce of gold in the USA would be $35. That was the price of US dollar. And all the other currencies would be determined, the value of all the other currency would be determined against the US dollar. So it was decided that all the participating countries would follow a fixed exchange rate between its own currency with the US dollar. And the value of US dollar was tied against gold. Okay, so this is when the so-called fixed exchange rate regime started right after the Second World War. Okay, and all the participating countries, they agreed to maintain the value of their currencies within 1%. Later on, they expanded it to 2.25% of the exchange rate that they agreed at the Bretton Woods conference. Okay, they committed to try their best to fix their currency value at that rate. Okay. Now, how does a country do that? They do it with the help of the central banks, and we'll talk about it. Okay, we'll talk about it. How does a country, what actions does a country take to maintain certain exchange rate? Okay, we'll talk about it. But for the time being, let us let us focus on the history of exchange rate of international monetary system. And as I said, around 1944, the countries agreed to adopt a fixed exchange rate. This Bretton Woods conference, it is also important for another reason. At the same time, the countries, they adopted fixed exchange rate, and they created two organizations, two important organizations. First of all, they created a common fund. All the participating countries, they created a common fund which consisted of gold and some major currencies, okay, like the US dollar, pound sterling, okay. They created a fund, a common fund for all the participating countries, which is known as the International Monetary Fund. Because if you want to maintain a fixed exchange rate, whenever there is a destabilization, you need large amount of fund to converge to that fixed exchange rate. Okay, so the International Monetary Fund emerged uh, with the objective to stabilize the respective currencies, to stabilize the currencies of all the countries. And you know that recently, uh, Sri Lanka, a South Asian country, is struggling. Its currency value has gone down tremendously, and it is the International Monetary Fund, uh, which is trying to help and bail out Sri Lanka. And IMF has done it before with other countries, okay? uh, even with Russia. They tried different countries, Russia, South Africa, South Korea. They tried at a different point in time in history. They tried uh, with that common fund that was created initially with 45 countries, but now there are 193 partner countries of International Monetary Fund. That fund is used to stabilize the currency values. And at the same time, another organization was created, uh, a bank to finance long-term development projects. This bank is also known as the World Bank. Okay. So uh, before we go to the next point, there is another important innovation which was introduced uh, at the Bretton Woods, the so-called special drawing right, okay, or the SDR. The SDR is an international reserve asset which was created by the IMF to supplement existing foreign exchange reserves. So each partner country of IMF, they hold deposits in the IMF in one of the five major currencies of the world, which is used as their own international monetary reserves, okay, along with its official holdings of gold. So as I said, the purpose of IMF is it is a common fund, the world's common fund used at the time of crisis. Okay, so at the SDR, 42% of the assets are denominated in US dollar, around 31% denominated in euro, almost 11% is denominated in Chinese renminbi or Chinese yuan, 8% denominated in Japanese yen, and the remaining 8% is denominated in pound sterling. Now, as you can see from this chart, we had seen fixed exchange rate from 1944 to 1973. So what happened at the beginning of the 1970s, uh, as I told you, up to this point, each currency was traded as a fixed rate against the US dollar. But around that time, uh, people were losing, or countries were losing confidence in the US dollar because there was a huge trade deficit in the USA. Okay, we'll talk about trade deficit in the next week when we'll talk about balance of payment. So for the time being, I'm telling you that um, the United States imports more than it exports. So what happens when you import more and export less? That means you are spending US dollar to buy stuff from other countries. So that created a huge outflow of the US dollar. And around that time, there was a crisis in the crude oil market created around the 1970s or 71. The Richard Nixon government failed to uh, failed to maintain the confidence level that people used to have, the other countries used to have with the US dollar. So uh, other countries, the stock exchange market, they decided to move from a fixed rate regime to a floating rate regime. So this history is very nicely described in your textbook. Please go through it. What happened in 1973 is that, like, for several weeks, the international foreign exchange market stopped operating. They didn't work. Okay, they stopped their buying and selling currencies. So once they opened up, they decided to determine the currency values in an open market, okay, in a market mechanism, through a market mechanism. Okay, so I'll talk about it in a greater detail, how we determine the currency value in a floating exchange rate regime. Okay, that is one of our major tasks today. We'll talk about how we determine currency values in a floating exchange rate regime. So around 1973, we entered into a floating exchange rate regime. 1997 is another important year when we saw the Asian currency crisis. Again, we'll talk about the Asian currency crisis briefly, but later on. So around that time, after that time, what happened is emerging countries, okay, emerging countries started playing an important role in the international monetary system, like China. Okay, so that's why we call this era as an emerging era. Uh, the bottom line here is that in today's world, we see most of the major economies, they adopt floating exchange rate regime. And some countries, especially the emerging countries, they come in and out of floating to fixed exchange rate. So we'll talk about them in a greater detail. So for most of the emerging countries, they, as I said, come and go forth. So this is the brief history of the international monetary system. I already talked about this. Excuse me. Okay. Yes, I did talk about it. Okay, yes. Voting era. Yes, this is how uh, mm, uh, the value of dollar changes over time, the value of US dollar. Okay. So the value of US dollar was fixed up to the, the first 2 or 3 years in 1970. Then uh, the US dollar devalued in February 1973, when this is the time when countries lost confidence in the US dollar and they adopted a free-floating exchange rate mechanism. And since then, you can see that the currency of US dollar fluctuated. Okay. And this is the index of dollar created by the Bank for International Settlements or the World Bank. Okay. Okay. Emerging era. Yes, I already talked about it. Uh, okay. Before going there, yes, that's all kind of. That's all.